Hello, thanks for joining me. My name is Paul Gardner, and I'm sitting here today with two wonderful individuals who know a lot about finances and money. I'm sitting here today with Troy Holland, who's the president and CEO of HIC Financial. Basically, Troy's on Wall Street, so knows a lot about the intricacies of money. I'm also sitting here with Womack, and Womack is the president and CEO of Positive Push. And he'll explain a little bit more about what Positive Push is. But again, Womack knows a lot about money. Now let's slide right into the topic of money, guys. Today, what we want to start off with is the fact that in terms of the stock market is seeing incredible rallies. It's in the midst of a historic rally right now. But yet, you've got folks like Warren Buffett, John Paulson, and George Soros taking their money out of the stock market at the same time that the middle class and upper middle class are dumping money into the stock market. Troy, let's start with you. Why do you think that George Soros, Paulson and Warren Buffett are taking money out of a mechanism, American mechanism, that's really, really doing well right now?
Well, the stock market has rallied over the last 3.5, 4 months. And the big guys know nothing goes straight up, and the stock market has gone straight up. So you could have people pulling money out of the market, those big guys, just because they expect a correction or, it's just a slight pullback. I actually think, I'm convinced it has more to do with the correlation between the dollar and the stock market. When the dollar goes down, the stock market goes up. When the stock market goes down, the dollar goes up. That way, recently, over years, the stock market has only gone up in nominal value, not in intrinsic value. So what's going on in Europe, in my opinion, is what's really causing the problems. Because right now, and we're in Europe, you have the issues with Cyprus amongst a lot of countries, but the Cyprus bailout recently has made everybody a little bit nervous. And you watch the euro decline from its highs of $1.32 recently down to as low as 128 recently, with the expectations that the euro is going to continue to decline compared to the dollar to about $1.20. So if the big boys, especially Soros, who's a currency master, if he's in anticipation of the euro declining, then he knows that the safe haven outside of the euro is the dollar. So they're expecting money to flow from the euro into the dollar. And if that happens, you're going to see, if there's more demand for the dollar, you're going to see the dollar strengthen. And if the dollar strengthens, typically the markets go in the opposite direction of the dollar.
What's your take on it, Womack?
Man, my take is what Troy said.
Right. So would you invest in the stock market today?
Yeah, I mean, I think what it really comes down to is probably something that could even be, I don't know, even more sinister than that. I mean, the fact is that I think a good analogy was made a few days ago. I heard somebody say it's like what happens to the animals right before a tsunami hits. All the animals disappear, and then the tsunami comes.
Right.
And we didn't know it was coming, but the animals did. So I'm saying that Soros and Paulson, and they're like those animals.
Buffett or the animals.
Yeah, because they're tethered to an understanding about markets and how they operate, and even certain people who help to dictate what happens in those markets in ways that average people aren't. So what I think happens is that whether it's through information or it's through the process of investing on the level that they invest in, that they have senses about where that market is going, and that what we're seeing as they pull out of the markets are a reaction to what I think is forthcoming.
Right.
So now exactly what that is, we got to dig deeper. We have to really look at what's happening on a broader scale. Everything now is connected globally. So we can't just like the United States, we just used to look at it like it was in a vacuum, but it's not anymore. Our economies are connected, and they're connected forever, and in ways that we can't undo. So to analyze the problem, it's back to what Troy said. Really, you have to analyze, and not necessarily the problem, but the issue. You have to analyze it globally. What's going on globally? We have some indicators of what's happening globally in global markets. Now we really need to look at, well, then why would some of the wealthiest people in the country who arguably own the largest shares of stocks in some of the most productive and the largest companies, some of them blue chip, some of them not, why are they pulling out? They're pulling out in large numbers.
Right.
And they're not just pulling out, they're not just pulling back on some of the stock, as we've read, and what you should do is just read some of that article. It talks about them taking whole amounts of stocks out of companies.
Let me get into it. So, Warren Buffett, his holding company is Berkshire Hathaway, and Berkshire sold roughly 19 million shares of Johnson & Johnson and reduced his overall stake in consumer product stocks by 21%. Berkshire Hathaway also sold its entire stake in Intel. Now, Buffett's not alone. So his fellow billionaire, John Paulson, dumped 14 million shares of J.P. Morgan Chase. Paulson's fund also dumped its entire position in discount retailer Family Dollar.
See, now that's the stuff right there that really is more concerning.
But see, it's not as concerning for me as
Wait a minute.
alleged.
You say it's concerning. You say it's not.
Well, the reason is because
What do we say?
because
What's going on?
I don't think it's as much sinister as, I mean, if you look at where, and I don't follow JP Morgan, as a matter of fact, I don't follow most of these stocks that you're referring to. However, when Family Dollar, I'll give you an example, we looked at Family Dollar. We thought Family Dollar was a very good opportunity in 2008. And the reason why is because we had the mindset that the U.S. economy was in trouble, and we felt like the people who shopped in the department store was going to find their way to Walmart, but the people that found their way to Walmart was going to find their way to the dollar store. So because that was our mindset back in 2008, then what we saw and what we expected to see was companies like the dollar stores and the Family Dollars, and I mean even KKR has Dollar Tree. That's a big private equity firm that went public. They own Dollar Tree. So our mindset was kind of on the same line as those, that in this down economy, what you're going to see is those stocks go up because more people decided to go to those stores.
Right.
So when you look, the question that needs to be asked, and I don't have the answer to it, is how long were they in those positions? I mean, because if I'm in a position,
you mean like Paulson in terms of the dollar?
Exactly.
Was it Dollar Tree or was it Family Dollar? Family Dollar.
Any of those companies. I mean, even J.P. Morgan. I mean, every financial stock was murdered in 2008. So if you were one of those smart people that decided to get into the market and buy those stocks at an early time, which those guys are smart enough to do, I mean, they might have enough returns on those type of investments to just pull the money off the table. I mean, at what point is your percentage good enough? If I put my money into a market, if I put my money into a company, and I already have my exit strategy, I've kind of already put a decision on what I believe the value of the company is. If that value goes up or down, it's whatever. But at a certain point, if I say, hey, the company's at $20, and I think the company, and I'm just making up stuff.
Yeah.
But if the company's at $20, and I've done a valuation, and I say, hey, based on this valuation, the company's worth 26. If the company goes to 28, if the company goes to 35, that's its business. But if my valuation says 26 and I buy it at 20 and it goes to 26, I'm out.
And so you're saying, Troy, even if the company is doing well, and let's say it's doing better than expected, you're saying to me, a guy like Paulson, who has not like an average person, 10,000 shares, he's got 19 million shares, I believe is what you read. 19 million shares.
Thing.
But let me ask you this. If 19 million shares goes up $1 a share, that's 19 million bucks you just made.
But here's the thing: when you're managing portfolios, and I manage funds.
Yeah.
So as a fund manager, you do valuations on company after company after company. So, at the end of the day, every fund manager is looking for the best investment. So and again, it's all based on valuation. I mean, every day we're doing valuations on companies. That's not who I am anymore. I'm not a fund manager anymore, but as a fund manager, reflecting back, when we managed funds, we did valuations every day. Every day we value companies. But the day that would go past that we didn't value company after company, making sure we found the right company that was the strongest in the sector. There's always a company that's going to go up further. But if I got a company, we're just going to use the number $20 again. If I value in a company and it's at $20 a share, and maybe the valuation comes in at 18.
Mm-hmm.
Well, I'll short that company.
Mm-hmm.
If the company is going up to 22, all right, from 20, maybe I'll go long that company. But in reality, both of those are the same. Mm-hmm. But if I'm valuing companies all day, every day, and I only have a certain amount of money to allocate, now we're speaking from a fund manager's perspective, but I find a company, and they're out here, that is at $20 a share, and that company, based on our valuations, at 25,
right?
Then I got to move that money because they only have XYZ under management. I'm not saying that that's what the case is. I'm just saying that if you're managing money and you look at every opportunity that's out there, if one can go up or down more than another position, then you got to get out of one and get into
another.
another.
I understand that.
Mm-hmm.
I understand that from a pure investment standpoint, a pure investment strategy. I understand it. But here's what I don't understand, and this is why I use the word sinister. And I use it loosely. I use it loosely. But here's why I ask: